Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today for another episode. As we got March Madness has already kicked off. We got Kentucky Wildcat fans getting ready for tonight's game. I know we went to school there, so I have to check that out. Didn't make a bracket this year. Busy tax season, and then of course. Um, Really one of the fastest drops in the S&P 500 that we've seen over a 20-day period of time. We're just kind of working our way through that. So I have a lot to talk about today, Ez. But before we jump into that, I'm sure you filled out a bracket. What's on the top of your ticket here, I guess?
Yeah, not to sound like a homer, but I am totally looking forward to see how any of the SEC teams do with that kind of record number getting in. So,
Yeah, definitely. It was. I think they had the most teams of any conference in the dance this year, if I'm not mistaken. But
I
like I said,
think
it's
it's
been
the
busy.
most bids any conference has ever been given, is what I understand. They got
Yeah.
14 teams total. So only two teams in the SEC didn't make it into the tournament, which, wouldn't you know, is my alma mater, LSU, of course, was left out due to their poor performance, as
Yeah.
well as South Carolina. So I'm excited to see how that's going to go. I don't think we'll see like a majority SEC Final Four. I do have maybe two of them going because I think that they are actually pretty good teams. But there are other good teams out there that aren't in the conference. It's just like if you take it respectively, it's the hardest one, I guess, is what people are saying. So
Yeah, it's a little asterisk though, right? Just because they expanded the conference to much more teams, so I guess that has something to do with it as well. But it's not like the SEC's been a joke of college basketball conference. No matter how many teams have actually been in the conference itself over the years. But
yeah,
yeah, definitely looking
historically
forward
one
to
of
it.
the worst performing basketball school conferences, them and the Pac-12. Since UCLA dominated in the '70s, it's pretty
Yeah.
much been Big Ten, Big East, ACC. They've been kind of the major performers. Big 12's been really good in this century. So
Yeah, hopefully we see some dramatic stuff though. I guess it's the only thing I'm looking forward to. Like I said, I didn't fill one out. Didn't fill out a bracket. Just extremely busy, but I would just like to see some drama, some fun, and definitely a few upsets for sure. I don't want to see nothing but number one seeds in the Final Four. That would be my only request. But I'm sure all those other number one seeds would be uh, fighting against that a little bit. So we'll see how it all goes. I'm looking
I'm s-
forward to it though.
I'm sure they will. We did get the dramatic Hail Mary. I don't know if you saw the play-in video or play-in game on. I think it was Wednesday. Full court Hail Mary, bobbled
Oh,
by a couple defenders, and like a layup with like 1 second left to win the game. It was pretty awesome. Of course, that team then just got smoked by Auburn last week. So
Auburn's pretty good.
Auburn's pretty good.
They dominated my cats this year. So,
Yeah.
anyways, I'm looking forward to watching it, but I'm going to catch up pieces of it here and there. It's been extremely busy, but this is why we do the program here, folks. You tuned into a good one today. I'm going to try to keep it tight as far as our timeline goes. Might be a little bit longer today. We'll just have to see how it shakes out here. But the reason why you would want to join this podcast, like, share, and subscribe to it, and continue to show up for it every couple of weeks when we drop these things, is because of what we're about to talk about today. Today is a great example of what this show is all about. So, a lot of news headlines has caused a ton of volatility, as I mentioned, over the last 20 trading days. Roughly a month of trading activity has been extremely volatile. But the reason why we do this show is because the news does a great job of bringing things to your attention. The news also, in my view, probably has understood this topic of behavioral finance better than any other entity on the planet. And what I mean by that, behavioral finance is a study you can get a PhD in pretty much every major university these days. And it's just a study that helps the student understand how human beings make decisions with their money under what would be perceived as quote unquote stressful circumstances. And we as humans would like to think that we're logical. But what we found from this study is a couple of very fascinating things. Number one, human beings are hardwired with this emotion or two emotions, many emotions, but two of which that they kind of focus on here. Humans are hardwired with fear and greed, and that has not changed since the beginning of time. Um, What we found from this study is humans feel losses twice as much as they feel good about making a gain. What that means is we are risk averse by nature. And the reason why I believe personally that the news understands this better than anybody is because almost all the news headlines are fearful in nature or something to cause some concern. The reason why they do that, they being the news, is because they are a for-profit entity. And that's not where I have a problem with the news. I am a for-profit entrepreneur. I am a capitalist. I am for making profits. So if you are in business or you work for a business, go make your money. I don't have a problem with that. What I do have a problem with is the news should bring things to your attention, scary or not. But why they tend to focus on the scary part is because they understand that human beings, again, feel losses twice as much as they feel good about a gain. In other words, we are twice as engaged with those kind of headlines. They grab our attention twice as much as something that would make us feel happy or positive. And that's just a human being nature. And the other thing that's important about this study is it pretty much has proven that human beings, we really haven't changed all that much in a couple thousand years. So there's all kinds of stuff that we cannot control related to investing. I mean, I could sit here between now and the United States 250-year anniversary, roughly a year and a half from now, and talk about all the things that you'll never be able to control as an investor. But if you do understand that we feel losses twice as much as we feel good about a gain, this ties directly into the number one reason that Warren Buffett, the best investor of all time, hands down, you can't even debate it with me. It's not debatable. His average performance since 1965 to now is 20%. That's the average. The S&P 500, the market over the same period of time is 10. Okay. He's the best. And the number one reason, according to Warren Buffett, as to why individual investors do not achieve the results that they're looking for consistently over time is they have no control over their emotions, their temperament. How we get control over our emotions and our temperament, because we're humans. I feel the 20-day almost in a row of declines throughout the major averages here in the stock market. I feel that. And I have to control my emotions as well. So, how do we do that? Well, that's part of what this show is all about. Yes, the news brings all these things to your attention. I'm about to re-bring that to your attention here as well. But I'm also going to point to what history has to say. In other words, how have other human beings behaved under this similar circumstances that we're going through here today? And without question, regardless of whatever it is that we're going through right now, tomorrow, 10 years from now, there's a precedent for it. The only time that you can say that there's not been a precedent is when they shut down the global economy for COVID for nearly 2 years. Okay, I will grant you that. There is no other comparison to be made there. But outside of that, there's a precedent. So the news does a great job of bringing things to your attention that's generally fearful because they're there to make a profit. I'm okay with that. But what they don't do, what we bring to the table here, is saying, hey, yes, this is what's going on, but we've actually been through this 13 other times over the last 75 years. And here's how the market performed under those circumstances. Here's where other human beings place their investments. In other words, of the 11 sectors that make up the market, where do they tend to gravitate towards under those circumstances? What performed the best of those 11 sectors? That does two very powerful things for you. Now you have full control over your emotions because you clearly can see how other human beings have behaved. You have an idea of what the risk and reward is for whatever decision that you make. And once you understand what the risk and reward is of the decision that you make, not only do you have your emotions under control, but now you can confidently go about making clear decisions that now have removed this thing called emotion from your thought process. That's what we bring to the table here at Shepherd Wealth Management. That's given us an edge for our clients. Now, for the compliance hawks out there, past performance is no guarantee of future results, and investing does involve risk, including risk of loss. However, um, I don't know how else somebody could control their emotions any better than understanding these particular topics here, what we're talking about. And I'm going to start with what I wrote using the research that we pay for here at Shepherd Wealth Management. We get it from all kinds of places. Fundstrat, Tom Lee's outfit, Barron's, CNBC, you name it, we consume it. Some of it's a bunch of noise and some of it's actually really important. And I write what we call a blog every Friday or nearly every Friday for our customers, just to help them understand what happened this week. Why did it happen? More importantly, what does history have to say? So I'm going to share the last Friday blog that I wrote to clients, at least some of it, with the audience today. So I want to take people just a step back a few days and then bring us right here to the present. So there's a ton of historical data about to be delivered your way here today. And don't forget, like, share, subscribe, the Shepherd Wealth Management Podcast. You don't miss any of this stuff. Okay. So we got CPI news last week. And I know that it's felt like a death of a thousand cuts. If you've been a market participant over the last, call it 4 months of investing activity. Now, February core CPI came in at positive 0.23 month over month, which is better than what market consensus expected of positive 0.29. So that was great. And in our view, this was a quote unquote clean number for core CPI, which just simply means that the downside reading in inflation is due to weakening of inflationary pressures. So inflation's coming down for the right reasons. And in our view, overall CPI was soft, again, for the right reasons, which is a good thing for stocks, especially compared to January inflation data. So we just got February's here in the month of March, comparing that to January's of this year. So January 2025 core CPI came in at a very hot uh, positive 0.45%. Now, when that news came out in January, this reduced rate cut expectations to nearly zero. Okay. So human beings had priced in over three cuts coming into 2025. We got that one print of data. And of course, the human being being fearful by its nature, right? The emotions are kicking in now. And the reason why they got fearful is, oh man, CPI came in hot here in January to start 2025. We got this new administration. They're going to, shake up all these different things. We have all these headlines that are saying those shakeups could cause inflation. And we just started the year off with a hot inflation report. Damn, market sell off. But not to the degree that we just saw. I'm about to get to where we're here today. Market rate cut expectations drop substantially. Moving on, shelter inflation. This is the largest weighting in the CPI calculation. We've talked about this as for years. Okay, how this has the longest lag effect. Well, now it's starting to behave appropriately, given that long lag effect that we've now waited for years after me talking about this. But shelter inflation is the largest. As I mentioned, this has cooled to a positive 0.29% month over month versus the positive 0.33 number that we saw in January. So coming down for the right reasons. And this was interesting as the quote recreation component of CPI, which obviously isn't looked at closely, not only by the Fed, but by market participants anyway. This is the second largest contributor to inflation for this month. This came in at positive 0.81 month over month. But in January, that number was positive 1.37%. So even though quote unquote recreational component of CPI inflation, which right now is the second largest contributor to CPI, is still falling precipitously month over month. And I'd be willing to bet that that's going to continue into the future. Used cars. So between shelter inflation and used cars, those were the two biggest things that were holding up headline CPI inflation for the longest time. We've talked about this for years. If you don't believe me, we have video evidence of over 1,000 videos over the 3.5 years we've been doing this. Go check them out. You'll definitely hear us talking about that. But used cars are the third largest contributor of inflation. That number came in at positive 0.88% month over month. And in January, that number was positive 2.19%. So used car price inflation is falling off a cliff. And we got some recent data today that would suggest that that is for sure going to continue. Now, auto insurance is the second largest contributor to inflation in the years 2023 and 2024. Again, I've talked about this for years. This has obviously dramatically slowed. Auto insurance inflation for February came in at positive 0.27. In January, that number was positive 1.99%. So again, inflation is cooling for the right reasons. This is a massive deceleration in auto insurance inflation, and it's obviously a good sign. Matter of fact, overall, 52% of core CPI data points, that basket of information that they use to calculate inflation, 52% of that basket year over year inflation rates are back to trend. And this is above the 50% average seen over the past 20 years. So, on average, these core CPI basket data points, um, we're doing better than that already over the past 20 years. Now, you're not hearing any of this on any news media outlet. I don't care what you watch, Fox, CNBC, you're liberal, you're conservative, you're an independent, none of them, not one of them. And I watch them all. I consume the data from every angle. None of them have said this, including the Fed in their most recent meeting. Now, they did say some positive things. We're going to get to that here in a second, though. Now, the above data lays out the reasons why we expect excellent returns for clients in 2025, because what's the concern? It's not inflation anymore, it's tariffs. I'm about to get to that here in just a second. Okay. And the market's starting to price that in, more rate cuts. And again, I'm gonna talk all about that here in a second. Now, however, not all investors, not all humans believe inflation is under control. And we're gonna break this down here for folks. And this is kind of where the volatility lies. So we just got the University of Michigan 1-year inflation expectation survey, and this is by retail investors, and we broke it down into political viewpoints. All right, so all investors participating in the S&P 500, the majority of them are right here in the United States. Obviously, there are international investors as well. I'm talking about U.S. stock investors here. They fall under one of three categories politically: Republican, Democrat, Independent. So we can actually pull this data set. Now, Democratic investors, humans, okay, these are all humans, but they just identify as Democrats politically. They feel, looking at this University of Michigan inflation data, they feel inflation is going to spiral out of control due to tariffs specifically. And the expected inflation 1-year expectation for these investors in the University of Michigan survey is showing that they expect a 6.5% inflation rate 1 year out. And this is way above the 2.8% year over year inflation results that we just got this week. Now, Republican investors, also human beings, they feel like inflation is already not a problem. They see inflation as zero, actually. These investors are obviously in conflict with the Democratic investors. Again, these are all human beings. So, can we see why the headline risk is really the problem? Tariffs specifically is what is being pointed out to you here by these investors in this University of Michigan survey. So if you're a human being and you just happen to identify as a Democratic investor, you see as inflation going spiraling out of control. 6.5. Republican investors, also human beings, think inflation is actually zero at this point in time. At least they expect inflation to be zero, 12 months out from now. This is a 1-year inflation expectation survey by the University of Michigan. The answer is probably somewhere in the middle, right? Like most things in life, which makes perfect sense to me. So you got year over year inflation, headline inflation 2.8%. Um, Other humans, Democrats, think that it might be twice that or higher a year out from now. And again, Republican human beings think it's basically zero 1 year out from now. The answer is probably somewhere in the middle. And it makes perfect sense to me because that's roughly right. If you're expecting 6+% inflation, some people expect zero 1 year out. Well, if it's in the middle, it's right around 3 to 3.5, let's say. I would argue that that is actually exactly where the Fed would like to take its monetary policy rate. They believe that the neutral rate of inflation, right? So right now we're between 4.25% to 4.5% Fed funds rate. The Fed themselves believe that the what they call the neutral rate is going to be somewhere between 3 and 3.5% Fed funds. What does the neutral rate mean? It just simply means that the Fed has taken their monetary policy rates to a place where it's neither stimulating the economy nor holding it back. It's neutral. Can we not see why this headline risk is causing the emotional result that we've seen over the last 20 days based on this simple survey that's done all the time. We get a University of Michigan survey all the time. Okay. And because we're humans, we're investors collectively, and some of us identify politically one way versus the other. This is the conflict that you're seeing because it's not being shown up in any of the hard data. The soft data is showing the emotions of investors right now based on these types of surveys. But when you actually look at things like underlying inflation, corporate earnings, which was 17 plus percent out of this recent corporate earnings season, you remove energy from the equation. The only reason why you would remove energy is for two reasons. One is one of the smallest sectors of the S&P, weighting wise, and the other reason why is because the energy prices have fallen substantially. Okay. So their earnings wouldn't be as good if those commodities were at a higher price. So you strip out energy, 20 plus percent earnings growth. I mean, I can go on and on. I've just broken down the inflation data that we just got here for you, but these are the highlights of coming into 2025, what investors care about. Forget about the politics for a second. They were definitely worried about inflation and interest rates, the Fed. They were certainly worried about corporate earnings. They were hoping to see that kind of earnings result. So, what is it? It's none of the hard data points. It's 100% these soft data survey points. And it's because we're humans. I'm about to bring you to modern day times, but we're going to look back at other points in time here, like Trump 1.0 administration, in just a little bit. Now, before I get to that, I have to get to this. Equity markets, stock market, S&P has fallen 10% in the past 20 trading days, right? Roughly a month. This is the fifth fastest decline in the S&P 500 in 75 years. Um, the precedents in other instances where we've seen this happen over the last 75 years has all been, in our view, quote unquote, rage selling. And these panic declines saw reversals 1 month later. What is notable, though, is that 10% drop in equities surpasses the related move in corporate bonds, which remain stable. And this is notable because corporate bonds tend to sniff out a recession way ahead of stocks, certainly usually. And we know the reason stocks are down, but we think corporate bonds held up due to what we view as a Fed put coming into play. That was evident based on what Fed Chair Powell had to say. So I'll come back to this Fed put idea here in just a little bit, but we saw a lot of selling, all right, over the last 20 trading days. Now, here's the other interesting fact. Since 1929, the median decline of stocks in a recession, right? If we're going to take the conversation to recession, which again is only being seen in the soft data surveys, not in the hard data, I don't believe that this is going to be an issue at all for equity markets, this word of recession. But let's just take it there. So since 1929, the median decline of stocks in a recession is 24%. So the 10% decline that we saw in the past 20 trading days would imply that we need to see another 40% drop in the S&P 500 to get down to median decline levels um, for recession. Are the actual odds of that high? I would argue it's not even close. Now, let's take another look at this from a different angle. Since the real concern is tariff, right? And depending on where you identify politically as an investor, you have a different viewpoint of this. Okay. Well, let's look at it this way. The four regions that are targeted by these Trump tariffs: Canada, Mexico, Europe, and China. Obviously, there are others. These are the big four. Since February 11th, all four of these markets are outperforming the US market. Therefore, outside of the USA, markets do not see a prolonged trade war. Otherwise, why would they all be positive? And there's smoke in the S&P performance-wise year to date, by the way. See if I can quickly get to that data set for everybody. Yeah, China up 19% since that day in February. Europe up 12, Mexico up 8, Canada up 2. Are you kidding me? Our economy is about $40 trillion. Okay, to put that in perspective, Canada's economy is about, let's call it 1.5 trillion. So who do you think tariffs are going to impact the most from an economic perspective? All right, it might hurt us for a second, but it's going to destroy them if you just want to be directly honest about it based on the size of the economy. Okay, but Of these four target regions of these quote unquote Trump tariffs that have a deadline of April 2nd coming up here, as far as reciprocal tariffs go, I'll have something to add to that here in a second. But the rest of the world, investor wise, doesn't seem to think that the trade war is prolonged at all. Otherwise, why would these much smaller economies be dominating the performance of the S&P 500 since mid-February, where all this sell-off started to happen? Doesn't make any sense. Here we go. Now, since 1950, there have been 6 cases where stocks fell 10% in less than 20 trading days. Okay, so 1950 to now, there have been 6 cases where stocks fell 10% in less than 20 trading days. Here are the dates: February of 2020, COVID happened. Number of days markets are down, 8 days. February of 2018, that was Trump War 1.0. Markets were down 13 days. October of 1955, Eisenhower had a heart attack. Markets were down 18 days. June of 1950 was a Korean War. Markets were down for 17 days. October of 1979, Paul Volcker increased interest rates to north of 20%. Markets were down for 20 days. October of 1997, we had an Asian financial crisis and markets were down for 20 days. Okay. So those are the instances since 1950. Each of the above is a quote, sell first and ask questions later moment for investors, especially at the start of the pandemic. And even at that time, equities fell 10% in only 8 trading days. We lost more than even under those precedents. But here's the good news: the stock market was higher 1 month, 3 months, 6 months, and 12 months later under all of these circumstances. The only data point here where that's the exception is 1 month later after COVID, markets hadn't fully recovered. Obviously, 2020 was a great year for stock market, double digit year, even though we had COVID in there. But 1 month, 3 month, 6 month, 12 months later, 6 of 6 times. I'm sorry, 6 of 6 times, 3 months, 6 months, and 12 months later, the market was positive. Here's the numbers. 3 months later, market was up a median of 9%. 6 months later, market was up a median of 15%. 12 months later, market was up a median of 21% after all this fear selling. Now, the tariffs that are set to go into effect, reciprocal tariffs on April 2nd, one might be tempted to argue that going away for the next 3 weeks might make some sense. However, this is premised on the notion that April 2nd is the date of resolution. That is, that tariff negotiations could see a breakthrough before April 2nd. In 2018, Trump 1.0, again, this was another instance where we saw a very fast drop in stocks. I'm gonna tie that all together here with present day data here in just a second. But in 2018, Trump 1.0, stocks bottomed well before the July 2018 tariff deadline. And let's go back even further. In 1962, the Cuban Missile Crisis shows that markets bottomed well ahead of the actual conclusion of the crisis. The crisis lasted 12 days and stocks fell 5% in the first 7 days of the crisis. Stocks rallied 4% in the following 5 days. In other words, they recovered two-thirds of their losses very quickly. And by the way, in 1962, equity markets bottomed halfway into the crisis. And at that time, it was World War that was threatened between Russia and the USA. The tariff wars are far less risky in terms of lives lost, but the stock market has fallen a greater amount this week than even then. Now, our belief on that particular point is, unlike 1960s, we have these smartphones. We get data much faster, almost instantaneously. Whereas, you would certainly have to go look for that or wait for, the following day's newspaper to bring that to your attention. So obviously, news moves much faster these days. So there's a little step back in history. I'm about to bring things more to the forefront of what's going on today, since that was something that we wrote to investors last Friday. Now, Where I want to take the conversation here is more along the lines of tariffs. Um, Pull up the data set here as now tariff related drawdowns have not been long lasting and have presented buying opportunities. So here we go. 2018 markets were rattled by President Trump's initial tariff threats. He made those threats at Davos, Switzerland. That led to a 12% decline in the S&P 500 over 10 days. Now, this was followed by another 9% pullback after the formal tariff announcement in March. However, by September of that year, the S&P 500 had not only fully recovered but was up 9% year to date. And the only reason why you saw markets get rattled at the end of 2018 is Fed Chair Powell famously said, quote, a long way from neutral. Again, that neutral rate I just referred to. He made that comment in October, which triggered a very hawkish reaction by stocks, declining 20%. So Fed Chair Powell had to immediately come back out, I think that December, and start to cut rates. He had to reverse a whole 180 degrees because he had it wrong. He had the neutral rate way wrong, and that's what freaked the markets out. I think he's learned quite a bit of lesson on two things. One, what the neutral rate of the economy actually is, because rates were much, much lower. Fed funds rates were around one and a half, one and a quarter, one and a half. Today they're four and a quarter, four and a half. It's a completely different environment. Let's fast forward to 2025. The setup is somewhat parallel to that. Again, we look at history. We look at the market through a lens of history. This year, the S&P 500 began with a 5% rally to the upside. Now, we just talked about a 10% decline over the past 20 trading days following new tariff rhetoric February 19th. So, first month and a half of the year 25 was awesome. Shepherd Wealth Management clients were doing even better than that. And then we saw this precipitous sell off over the following 20 days due to tariff headline news. Even though we've already talked about all the hard data, it's been nothing but awesome, exactly what you would hope to see. But here we go. The current correction, much like in 2018, could set the stage for a rebound in markets as an eventual tariff resolution is resolved, or at least becomes more clear and palatable for the market. Now, crucially, unlike 2018, as I just mentioned, today's backdrop is supported by a Fed that is already dovish, based on what Fed Chair Powell had to say in his press conference this week. With the Fed funds rates currently being about 4.5, again, compared to last time in 2018, as a similar Trump 1.0 comparison, rates at that time by the Fed was 1.5. So we're seeing cuts on the horizon. And at that time, in October of 18, the Fed was talking about taking interest rates up to what he thought was a neutral rate that was much higher than where they currently were. Obviously, you got that wrong, or he wouldn't have been cutting just a couple weeks later. Now, a historical lens reinforces a couple of things here. Leading into 2024 presidential election, the VIX, the volatility index, the curve collapsed after President Trump's victory was confirmed in early November. In other words, people were expecting a ton of short-term volatility leading up to that election, and then volatility would be not so much of an issue after everything was completed. But the VIX curve was so inverted, mostly due to the fact that people thought that this election would be challenged. In other words, we wouldn't know what the results would be for many, many weeks, maybe months after. Well, that wasn't true. And we saw a heck of a recovery in markets under those circumstances. And as we sit here today, we're seeing exactly the same sorts of data points in the VIX. But one interesting point from Fed Chair Powell's press conference is after the announcement was made, the Fed's decision to pause rates, the S&P posted a multi-day high after the meeting. We recaptured our 50-day moving average, and rate cut expectations rose from 2.2 cuts to 2.6 cuts after his announcement. Now, the Fed's summary of economic projections, dot plots, if you will, the Fed did cut its GDP growth forecast, and meaning they expect a little less growth, and they raised their inflation outlook. Now, that combination should have been like sending the markets down big time. Yet, the risk assessment data showed a distinctly dovish tilt. And the reason why the market took it so in stride is because one of two things. Number one, the Fed still said cuts. Right? They still expect to cut rates this year. But 90% of Fed members, number two reason, 90% of Fed members cited heightened uncertainty around GDP growth. And that was up from 45% 3 months ago. So, in other words, before this administration came back into office and started to implement and talk about trade policy, roughly right in the middle of February, 3 months prior to that, everybody was expecting not only cuts, we were expecting more growth, less inflation, and the Fed was very confident that that was going to happen. But now we get to mid February and all this talking points come out, not hard data, soft data, talking points come out. And now the amount of feds that are uncertain doubles. And more importantly than that, 90% are also noting that risk are weighted to the downside for growth. And that's up from 25% just 3 months ago by Fed voting members. Okay. This soft data point by the Fed is directly correlated to the soft data point that we just talked about in the University of Michigan survey, depending on where you fall politically. So we had to know how many of these Fed voting members fall into one of the two categories. Well, overwhelming majority fall into the Democratic category. Now, these are humans, they're investors. I don't care how they identify politically. I don't have a political opinion to share with you here. That's not why I get paid. I'm just simply pointing out that human beings are flawed. We have biases and we tend to repeat our behavior over and over and over again. This is where the edge is for the individual investor is to understand how other human beings behaved under similar circumstances. Now, their own personal bias leads them to believe that growth is going to slow and inflation is going to increase because of tariffs. That's where the correlation connection lies in the University of Michigan survey. Okay. There's a high probability that they're wrong, much like in 2018, which we're going to get to here in just a second. Let's talk about some of these dovish signals that Fed Chair Powell provided during the Q&A part of his press conference. When asked about the inflation impact of tariffs, Fed Chair Powell categorized these as potentially transitory. Now, nobody wants to hear the word transitory any more than me because I bought that word transitory back when COVID happened. We shut down the global economy. We started to reopen things. And yeah, I can understand supply chains being screwed up and that having an impact on inflation. I bought the transitory thing. That was not really the problem. That was a one-time short-term shock. The real problem was the massive amount of increase in the money supply. Okay. I'm not going to have a M2 versus M1 conversation with the audience here today. That is for college corporate finance 307 or whatever. But long and short of it is we increased the money supply so much more so than there was demand for money. Interest rates came down, and that certainly spiked a ton of inflation. I don't think it was solely due to that. I think the supply shocks also were a part of that. I just bought the whole transitory thing being a supply shock. So nobody wanted to hear Fed Chair Powell say the word transitory. Matter of fact, he was directly asked, "Well, you said transitory last time, and that obviously, you were wrong." Well, he had to clarify the question and said, "Well, are you referring to the Trump 1.0 tariffs as your last time moment? Because that was, in fact, transitory, right? Everybody was expecting, just like today, those tariffs were going to cause a massive amount of problems, mostly inflation, higher costs. Well, tariffs were implemented. A lot of them were kept not only for that administration, but the administration after Biden Harris. And nobody, not one economist, not one Fed person can point to anything related to that causing inflation. It was, in fact, transitory. So that had to be clarified in the press conference. Now, this is in contrast to Fed staff research data points suggesting that tariff effects could be long term and impactful. Yes, I think everybody would agree that if you increase tariffs, whatever percentage, let's call it 25% across the board, on everything that's moved in and out of a country, and they stayed that way For all of time, yes, you would see an increase in prices across all of those things. That is not what happened in 1.0 version of tariff risk, and it's not going to happen here today. Now, on inflation expectations, Powell emphasized that long term expectations remain well anchored. And this is notable given recent sharp increases in short term inflation expectations by the University of Michigan survey. Powell also addressed financial conditions, acknowledging that market declines are material to the Fed's outlook, meaning the Fed does pay attention to when the market loses this much value under a short period of time. This is your Fed put. If they don't want to see markets drop like this for no real fundamental reason, they might step in. They also don't want to see growth be deteriorated due to all of these concerns. That's where rate cut expectations could rise, right? If the Fed's worried about growth slowing, well, part of their mandate is maximum employment. And right now, we're not seeing any sharp spikes in unemployment or layoffs. So you do have the Fed ready to take action if needed, if growth slows too much, if unemployment increases too much due to all this quote unquote uncertainty. Now, Powell also specifically said that the quote hard data has remained firm, meaning good. The soft data has weakened, prompting closer Fed scrutiny. He's asking the same question I am. Why is the individual human being reacting this way, given the hard data is awesome? Right? We've identified it. It's in the University of Michigan survey. The Fed pointed out as well. They just didn't break it down into the investors in that survey, in the marketplace, into their political category that they identify by. Now, getting back to my earlier point of markets getting way ahead of itself as far as selling off way in advance of a resolution of an outcome, whether it was the Korean War, the Cuban Missile Crisis, Trump 1.0 with tariffs, etc. The geopolitical developments hint at a possible tariff relief ahead of April 2nd. Edward Lawrence tweeted out the White House economic advisor Kevin Hassett have been in negotiations a long time, the Commerce Secretary and Treasury Secretary, to reduce tariffs ahead of the deadline. This suggests a resolution could come sooner than expected. Treasury Secretary Besant also confirmed that several countries are proactively engaging in negotiations to reduce tariffs. Gosh, I wonder why that is. Because our economy's 40 times larger than a lot of them? I don't know. Maybe that has something to do with it. Besson expressed optimism that some tariffs might be rolled back as key trading partners come to the table. This development, I should say, is underappreciated by markets, but could be a meaningful tailwind if a deal materializes. Now, I want to come real quickly back to the Mayhem Used Vehicle Index, which we just got on Monday of this week. It fell 1.6%. As I mentioned, this is one of the larger contributors to inflation alongside shelter, which is also falling precipitously. Since used car prices are a key component of core CPI, this drop could lead to lower inflation prints in the coming months, supporting a 1-year inflation forwards have declined from 2.73% a month ago to 2.45% currently. So some parts of the market are sniffing this out way in advance of others. I'm simply here to say in this particular podcast that you, we've just talked about the actual data points, the hard data points. We've also talked about the soft data points. And we've now compared that to other points in time in history where we've seen the market sell off this quickly. And in every instance, every time we can point to that decision by investors to sell as being emotional. Because if it was, in fact, a hard data reality, and let me give you some hard data realities 2008, banks that have been around for 150 plus years went to zero. That's a hard data point. Inflation In 2021, going into 22, up nine. That's a hard data point. 9.1% was peak inflation. Let's see. Let's go to the dot com bubble, 2000, 2001. I mean, you're talking about companies that haven't even gotten one customer, publicly traded companies, not one sale, and their PE ratio is 200 plus percent. I mean, that's hard data for you. Okay. The hard data is not marrying up with the soft data here. I don't know how else to make this clear for the individual investor listening to this right now. But this is valuable stuff here, and you're not getting this. I don't care what you listen to. You got an old school transistor radio. You know, wherever you're getting your information from, nobody's talking about this. This is valuable. This is an edge. This is what you need. So I really do hope that investors are enjoying this. And I'll leave you with one more, a couple pieces here. This is from the most recent Barron's. So I get news from everywhere. This is the most recent cover of Barron's. I like paper. I like technology. I get them both from Barron's. Now the cover of Barron's Mag is red, by the way. Mag 7 on sale. Four of the seven stocks are priced to buy. That's encouraging, making sense of a market turmoil as Trump turns up the pressure. Pages 12, 14, and 15. Now, they're showing Tesla down 49.8% right on the cover. Nvidia down 22.7, Microsoft down 19, Meta down 20, Apple down 19, Amazon down 20, Alphabet, Google down 21%. These are declines from their 52-week high. This all happened over the 20 days that we're talking about here. But we also get some, like I just said, here's a headline. As stocks tumble, bonds suggest calm. We just talked about this here. Bonds tend to sniff this out way in advance of stocks. Okay. I mean, I can go on and on here. Some of these provide some clarity. I got another one here. Rate cuts are coming, this economist says. But some of them are really trying to scare the hell out of you. And that's really what the point of today's discussion is to help bring a lot of this stuff to light. I really hope that this is something that you would want to pass along to your favorite relative, coworker, friend. If you've enjoyed this particular podcast, we'll be doing this every 2 weeks. You can like, share, subscribe to the Shepherd Wealth Management Podcast right on YouTube. And I'd love to hear your feedback and comments. Again, this is not a political statement. I don't give a rip of which side of the aisle that you fall under. What I do care about as individual investors, like I do for my clients, I want you to get the type of performance that you're looking for, that you deserve, and how to go about achieving it consistently over time. Because I don't get paid to have a political opinion. Okay. I get paid to help people navigate these treacherous waters, if you want to look at it that way, that we're dealing with. So they can have control, peace of mind, sleep well at night, and get the results that they're looking for, that they need. And in some cases, they deserve because they busted their ass to build up the type of wealth where they need to hire somebody like myself to manage and provide advice, guidance, tax suggestions, etc. I love my job. This is the most fun thing for me to do on the planet. I will continue to deliver this. And I really hope people don't take this as any political statement at all. In no way, shape, or form will you ever get a political statement from me. But we do want to give you the reality and try to make sense of what actually is going on here today. So, with that, we'll be back in a couple of weeks. And hope you guys enjoy college basketball. Have a great weekend. Baseball is right around the corner as well. I hope you guys have a good one. We'll see you in a couple of weeks.